What up, guys? It's January 30th, and let's go over this market alert. So, tomorrow, Monday, is the last trading day of January, and January has been awful for us. I think this has been the worst January ever in the stock market. I think that I was looking, and I look at a couple of people, and they're reporting, and I can't find a worse January than this one for us shareholders. But at the same time, the bear drowns. That's why I have this bear here, right? The bear may drown when you get such selling pressure and such negativity on the market can flip like that. So let's watch out. Let's keep our noses dry, kind of like this bear is trying to do. But I don't think it's going to happen. I think the market will flip eventually. But we're going to take care of our opportunities and take advantage of them. So let's get going. Of course, before we get going, hit that like button, hit subscribe. I appreciate your support. Hope you learned something from this, even if it's something little, and we have some fun in the meantime. All right, let's get to it. So here's the markets for tomorrow, guys. Here's the futures market. We're just up a little bit on the Dow, S&P, and NASDAQ, okay? There's nothing on the news really that's affecting stock prices at the moment. So Russia's quiet, Taiwan quiet, nothing here macro so far that's affecting the markets. But for this week, we have Friday's employment report for January, in which the consensus is 155,000 jobs added for the month of January. I think that's going to be missed. I don't see how the economy adds 155,000 jobs in January. I think there's too many jobs, not enough people. I think this is pretty much full employment here at the end of the day. If you want a job, there's plenty of them out there. Go find one. And employers are begging for people to come and apply to their jobs, and stop this unemployment craziness, because again, 11 million jobs are open in the U.S. No reason for nobody to not have a job nowadays. Now, moving on to the earnings week, brought to you by Earnings Whispers. These guys are nice enough to put calendars for everybody to see. You can see them online. So we're going to talk about this calendar. I'm going to go only up to Tuesday, because there's a lot of companies reporting here that we have to listen to and know what they are saying, right? Again, the importance of this calendar is that when your companies report, and you also listen to conference calls of companies that you do not own, because you want to know how the economy is doing, how these companies are faring in a high inflationary environment with supply chain issues still lingering. We want to listen to what they say and what they're thinking for the future, what kind of guidance they're giving you, even if you don't own them. Okay, so we're going to start with Monday. Before the bell, we got Otis Elevator. That's the only one that interests me as far as listening to a conference call. We do not own Otis Elevator, but we listened to that conference call to get a gauge on construction, specifically business construction and tall buildings that require elevators. This is a company that's an elevator company that's separated from United Technologies, I believe it is. Yeah, United Technologies. And now it's its own thing. So they've been doing really well. This is actually a surprising business that is profitable and does fairly well. Okay, nothing else that interests me for Monday before the open. But after the close, we got NXP Semiconductor. We need to talk about this one because I made a move last week on NXP Semiconductors. We took a position in NXP with the money we had from our sale of Lam Research. So Lam Research is another semiconductor machine maker. This is a semiconductor maker, okay? And they have 50% exposure of their business to auto, to cars, and this is a growing segment. So in my mind, this side of NXP is going to be extremely profitable in the coming couple years. I do not see NXP being under 300 in 2023. So this is a company here. We look at the valuation. Let's move on to that and look at the 1-year chart of NXP Semiconductors at 33 times current earnings and earning $5, $5.50 per share, and still expected at a forward P of 16 to grow at a rate of 11% this year, right? And this is 29 analysts with a consensus of 11%. I think this is low. I think the growth consensus should be closer to 15 to 20% because of the auto sector. And all these cars are going to start their rollouts in 2022, maybe towards the second half of 2022. You want to own NXP Semiconductor for that second half of this year, when all these electric vehicles like the F-150 Lightning, more Mach-E's, we have other stuff too, Teslas and all these other manufacturers that are going to use chips from NXP Semiconductor inside their vehicles. So this is a name that we're using, and we're using the weakness to add on weakness. Let me go back to the chart here. Actually, we owned this at about 192, 15 shares. I'm still looking to add to this position. I'm always interested in semiconductor exposure. Very, very, very interested, and you should be as well. Ask me if you guys have any questions on NXP Semiconductor or any other semiconductor company. I'll give you guys my thoughts free of charge, okay? Now let's move on to, let's see here, Cirrus Logic. That's the next one on Monday after the close. This is some Apple exposure. For those of you that don't know, Cirrus Logic does audio chips for iPhones, okay? And in your iPhone, whenever you feel some kind of feedback, some kind of vibration feedback from your iPhone, there's no vibration engine on your iPhone. There's nothing that really vibrates. The vibration is produced by speakers by Cirrus Logic. Same thing as your Apple Watches, guys. They have Cirrus Logic's chips, audio chips in there that create feedback that feels like a vibration, kind of like a little mini subwoofer. That's Cirrus Logic, okay? So if you want some Apple exposure, that is one here. And let me go over the chart here and the valuation for Cirrus Logic. We have here a $85 stock, $5 billion company. This is a small cap company at 21 times current earnings. Not bad. And we have EPS of $4 a share, so it's very profitable business, very, very profitable, and 15 times forward earnings. That's a good sign. Here we have, though, the growth rate is expected to be 17%. Not bad for 2022. The danger of these companies that are Apple providers, Apple suppliers, is that Apple may say, we don't need you anymore. We're going to favor our own chips, kind of like they did with Intel. That's the risk with Cirrus Logic, same as Skyworks Solutions, which we used to own. So if you own these companies, always in the back of your head, you're thinking, is Apple going to get rid of them? Is Apple on their next announcement going to say, we're making our own audio chips now, and Cirrus Logic gets devastated? So that's the danger there. Okay, now moving on. Nothing else here for Monday after the close that I'm interested in. But before the open, we got ExxonMobil. This is one of the giants of the stock market. It moves the markets. And these gas companies or oil companies have not been reporting excellent numbers because in Q4 of 2021, gas wasn't at what it is today, near $90 a barrel. I think the Q1 numbers for these oil companies are going to be significantly better, but it also depends on the rate of capital expenditures and how much you're spending to pump that oil, because that comes into consideration as well, and how much they're giving back in dividends to their shareholders. So at the end of the day, if you own an oil company, you have that your eye on the price of WTI crude all the time. You're listening to rig counts. You're listening to what OPEC is doing, OPEC plus. Not something that I'm interested in at the end of the day. The only oil company I like is Texas Pacific Land Trust. Look that up. It's kind of really hard to explain, and in 10 seconds, I'm not going to go over that. All right, now moving on to UPS. This is one of those legendary CEO companies, Carol Tomei, which used to be the CEO of Home Depot and took Home Depot's to higher and higher and higher levels. Fantastic CEO. The problem with UPS, it's its growth rate. So we see here the growth rate for UPS at 3%, 3.6% for 2022. And you're paying 4P of 16 for a 3.6% growth rate. Hard to swallow, in my opinion. But at the end of the day, this is the transition of the consumer from online shopping to retail in-person shopping. Who knows how that trend's going to pan out? Either way, United Parcel Service is a monster business, pays a dividend. So not a bad stock to own in this environment. But at the same time, we want to see, or you'd be essentially betting that they're going to beat that expectation of 3.60, which shouldn't be too hard. But at the same time, who knows with how the consumer is going to react this year versus last year on those comparisons. Okay, now moving on. Nothing else interests me here on Tuesday before the open other than Stanley Black & Decker. Now, this is an interesting business. Stanley Black & Decker, these are power tools, all kinds of stuff. And the valuation is quite interesting, guys. $28 billion business. This is a mid-cap stock making $11 of EPS, of earnings per share. That's a hugely profitable business, paying 2% dividend. I'm sure they can pay a 3% dividend and just laugh it off. look at this growth rate, guys. We got 18% growth rate 2021. 2022 is even higher growth rate of almost 20% growth rate, and we're paying a forward P of under 15 for Stanley Black & Decker. If you like this business and you like the fundamentals and you want a stock that is profitable, boring, something that does well in a high inflationary environment, this may be the one, guys. This may be the one that is definitely worth a close look here. I'd probably be buying or adding to my position here if I wasn't so outstretched in my portfolio. But if you're interested in a stock that does well in this kind of environment, and it hasn't really, I mean, look at this 1 year chart. It hasn't done well, but at the end of the day, this is a cheap valuation for Stanley Black & Decker, so maybe worth picking some Stanley Black & Decker in the future here. Now, after the close Tuesday, we got AMD. We own AMD, guys. Remember that. We own it, and we've owned it for quite a while. I believe since 2019, late 2019, maybe some early, late 2020, early 2021, we've owned this stock at $82 a share. So this is a mid-cap stock, $127 billion business that in the future is going to be $250 million and $500 million business. It's just a matter of time. Trading at 32 times earnings, profitable 3.2 for earnings per share, and growing at a rate of 20% for 2022. And I think that's low because this is another legendary CEO, Lisa Su, heading this business that is gunning for NVIDIA and has left Intel in the dust. These guys just grew at 65% in 2021, 65%. And I think that 20% is going to be closer to 30, to be honest. And just that compounded annual growth rate is just amazing for this business. And it's been beat up, guys. It's been a beat up business. Look at this 1 year chart. High of, let's see here, the 52-week range was 164. Now trading at 106, 105. Man, this is a silly sell-off in this stock. This is a powerful business that is just going to do better, and better. We have a forward P of 33. I could see somebody wanting to add AMD under 100. I think I'd be pressed to do it if it fell under 100, and then loading the boat under 90 if it ever went down under 90. I don't see no reason why you don't load the boat on this stock, and why I wouldn't do it as well. Currently 88 shares at $82 a share. I have no problem raising my cost basis on this stock, okay? Now moving on, PayPal. That's another stock that we own for the account. Okay, and a lot of institutions are building up PayPal right now. They're buying shares of PayPal, specifically in that 150 to 170 level. Right now trading at 163. We own about 50 shares at about 175, if I'm not mistaken. Totally okay with that. Trading at 40 times earnings. Seems expensive, but very, very profitable. $4 earnings per share. Very profitable. We have a forward P of 30 times the forward PE with an expected growth rate in 2022 of 18% roughly. And I think that is low. We have exposure to buy now, pay later. We have crypto exposure, which it's probably the reason that the stock has been sort of selling off because of its crypto exposure. But at the end of the day, crypto is going to do its thing. But with payment solutions, the Venmo deal with Amazon, this is a $250 billion business any day of the week. This is a $200 stock any day of the week in the next 6 to 8 months. So not worried about one bit about PayPal. This is my new Facebook type of stock. Very happy to hold PayPal for the future. Now here we have Alphabet. Moving on, Alphabet is one that you have to watch along with Meta. Same kind of family because of advertising budgets and YouTube and all over the internet advertising. Interesting to hear what's going to happen there. Advertisers have been reporting that they're not spending as much. So I'll be pressed to hear what they have to say about their advertising numbers and how that's going to carry the market. Because remember, this is a $2 trillion business in the market, and if it goes down, it's taking the market with it. It's taking the S&P down with it. It's taking the NASDAQ down with it. Just like Apple saved us last week, as far as the overall market, Google and Meta can cut us off and just undercut what Apple gained. Okay, so keep an eye on that. Now, General Motors is one that I will listen to because I own Ford. So General Motors, we want to hear about what they're experiencing with semiconductor shortages, what their supply chain issues are. And of course, maybe any news on the Chevy Silverado, the electric pickup they're planning for later this year. Maybe a price point would be nice. I know it's like $100,000 truck, but hopefully not. Hopefully it's cheaper than that. Ford is coming in cheaper any day of the week. We'll see, okay? But Ford is ahead of GM. I'd rather own Ford than GM any day of the week. Now, Starbucks is one that I'm not really interested in. I think supply chain-wise, China-wise, you may want to listen to that call just to see what's going on with China and their business there, but it's so overvalued, not even worth talking about for me, okay? And then nothing else here other than Electronic Arts. I always keep an eye on the gaming stocks because I like the gaming stocks. I think that gaming is a sector that has growth forever. Activision Blizzard now getting bought by Microsoft kind of tells you that these companies need to get involved in gaming for advertising, for the metaverse, for all kinds of things. Very important. I don't like Electronic Arts. I used to like Activision Blizzard better, even after the scandals that they were doing. In the future, 5 years from now, nobody's going to think about that anymore. But now since they're getting bought and the stock rose up for Activision Blizzard, can't buy it. But Take-Two Interactive is another one that you might want to look into if you're interested in video game stocks. And then nothing else here for the rest of the day. All right. Now, that's all I'm going to cover today because I'd probably be a 30-minute video if I did the whole breakdown for the week because there's a lot of companies reporting. But again, what's important is you listen to the conference call, read the transcript if you need to. I listen to it, then I read the transcript just to make sure I didn't miss anything, and actually take down notes and formulate opinions based on what they're telling you because that's going to be extremely important as far as being a good investor and doing your due diligence, okay? Let me know if you guys have any questions, guys, okay? Hit me up on the Stock Gladiators Discord. Hit me up on Instagram. The link is right there on YouTube for Instagram. Follow me there, guys. Peace out.